We don't think that we are over diversified in the ETF frenzy, really, because if you look at the general portfolio construction considerations out there, this is still a highly correlated market. Think about the relationship that stocks are supposed to have with bonds. They just haven't existed. They've been positively correlated for some time. And so, one of the things I think is really important, really even beyond ETFs, is to think about what are some characteristics in portfolios that will benefit clients that are not just tied to, again, what's happening with corporate earnings, which we think are still great, but that level of, let's call it portfolio symmetry, is a little bit higher than what we like to see. So again, finding a variety of categories that will do things besides just go up and down with the pace of the S&P, we think is critical. So again, not overly diversified within ETFs. You have to look for other things besides ETFs to really get that done.
So, Eric, I know within equities, you guys are overweight U.S. and emerging markets. Talk to us about emerging markets, how you view the opportunities there.
Yeah, Paul, it is certainly a index set that is really skewed to AI, and certainly if you look at South Korea, the effect of memory in particular. So that's something that we're certainly cognizant of as sort of being overly concentrated in that broader AI ecosystem trade, if you will. And again, I love Tom's characterization. This isn't a parlor game conversation whatsoever. But the idea that, this is a demographically very strong set of indices. You think about population growth, you think about even the improvement we've had in corporate governance across a number of EM countries. That's, we think, is still a positive thing to have exposure to within a portfolio. Again, people are very, I'd say very predestined to have a lot of U.S. equity exposure. If you live in the U.S., we have a lot of global clients. So seeing some of that non-U.S. exposure, we think is healthy and not just concentrated in the AI ecosystem.
There's some fancy mathematics, Eric Freedman, some dynamics here of a yield on a money market fund versus money flowing into equities. And, I don't want to make this a math project. It's August, but explain how Northern Trust sees yield in the short paper where funds flow into equities to buttress a bull market.
Yeah, it's a really important rate of change, really a stock and a flow set of relationships, Tom. And really the thing that we've been focused on, if you look at the idea of parking capital in cash, which again, over time is a wasting asset. It does not protect you against inflation. Certainly agree that the prints you all have been talking about over the next couple of days will be important, not just CPI, but PPI as well. And so what we've been emphasizing with clients is really moving away from just parking in like 3 and 6 month paper, whether it's treasuries or even commercial paper. We think there's a material pickup, especially for our taxable clients in munis. The spread right now, Tom and Paul, is something like 3.5 to 360 if you live in California. The tri-state area gets close to like 325. So having an opportunity to pick up some tax equivalent yield in munis and not just be so focused on sitting in cash, we think that's a great opportunity for investors to sharpen their pencils on.
Eric, we had a guest in earlier from Macquarie, and his business is infrastructure, and he was talking up infrastructure. How do you guys think about that?
Paul, it's a really under-owned category. We think of it as contracted revenue with an inflation kicker. Sounds like I'm marketing the Macquarie book, if you will. But the idea is that when we get involved in a infrastructure relationship, you're getting a couple things. We're getting some current carry, which is a positive thing. Not really the main driver of why we own it, but certainly we enjoy being paid while we wait. You also have some exposure to what's happening within those individual companies, whether you have an equity interest or a debt interest. We actually prefer equity interests because there are some opportunities for, again, that cross-platform transmission, if you will, of things like tolls and things like utility transfers that we think are, again, really enhancing. So we like the combination of both inflation protection with some yield, but also some upside participation in the equity interests.